One handle, two platforms. That handle is the only fingerprint they can't forge. If anyone DMs you for money, wallet addresses, VIP access, or signals, it's a scam. I sell nothing. Ever. Now drop same day in the comments if you're actually locked in. Because today's tape was a stress test that exposed the system in one snapshot. Silver crashed about 7%, while gold hit an all-time high print near $5,117 on some feeds on the same day during a war. If that felt impossible, you're thinking in a calm market framework. This is not a calm market. This is a stress market. And in stress markets, price doesn't move like a clean story. It moves like a survival machine. Stop. This matters because this same-day divergence is not a contradiction. It's a signal. It's the market telling you fear is real and liquidity is fragile. Gold is the trust hedge. Silver is the friction hedge. And friction doesn't move smoothly. Friction snaps. So if you've ever asked, how can gold scream all-time highs while silver gets punched in the mouth on the same day? This script is your answer. And I'm going to do it the right way. No conspiracy, no vibes, just plumbing. I'm going to show you why this happens, what it means, the three traps that wipe people out when they see this divergence, and the one behavioral tell that decides whether today's silver crash was the beginning of a breakdown or the cleansing before the next squeeze leg. Let's start with the environment. This isn't happening in a vacuum. Major market coverage today described a risk-off shock as conflict escalated in the Middle East. Oil surged sharply, stock futures slumped, and investors ran to safe havens, gold around $5,400 and silver around $95.40 in early moves. Investopedia.com. So yes, safe haven demand is real. Gold is being bought like insurance. But here's the twist. The same day, silver can still get slammed because silver is where leverage gets flushed first. And this isn't a guess. Financial coverage described exactly that kind of session. Gold surged while silver futures declined after initial gains, the whipsaw that confuses everyone. Barron's.com, gold trending, silver whipping, same day, same war. Now we solve the puzzle. There are three clean reasons this divergence happens. Reason 1, forced deleveraging. Reason 2, gold-only fear. Reason 3, liquidity preference and collateral selling, and you need all three or you'll keep getting trapped. Reason 1, forced deleveraging. In a war tape, volatility spikes fast. When volatility spikes, brokers demand more collateral, risk desks tighten limits, and leveraged players cut exposure. They don't cut because their worldview changed. They cut because they have to. And in a leveraged market, have to means sell what you can sell quickly. Silver is liquid. Silver is volatile. Silver is higher beta than gold. So silver becomes the sell button. That's how you get a day where gold is strong because insurance demand is rising, while silver is weak because leveraged positioning is getting flushed. And once silver starts dropping, volatility rises even more, which increases margin pressure, which forces more selling. That's the cascade. That's the plumbing. Reason 2, gold-only fear. In the first wave of a crisis, big money chooses gold first, because gold is pure safe haven. Silver is mixed, part monetary, part industrial, higher volatility. So big allocators buy gold and hesitate on silver until the market proves the shock will persist. That creates a phase I call gold-only fear. Gold goes up, silver whips and can even fall. Then, if the shock persists and turns into inflation and logistics consequences, silver joins later and can outperform violently. That's why a silver crash on a gold high day doesn't automatically mean silver is broken. It can mean we're still in wave 1. Reason 3, liquidity preference and collateral selling. In a crisis, people sell what they can sell, not what they want to sell. If equities wobble, credit tightens, oil spikes, volatility rises, someone needs cash. They sell winners, they sell hedges, they sell anything liquid. Silver is liquid, so silver gets dumped even if the long-term story is bullish. This is the ugliest truth in markets. In the first wave of crisis, people don't sell what they want. They sell what they have to. Now stop, here comes the trap that wipes out most people. Most people see silver down 7% and assume the story is over. But in real markets, a forced selling day can be the most bullish event if it fails to break the underlying bid, because forced selling flushes weak hands. It reduces the number of forced sellers left. It creates air pockets. And then the next wave of buying hits a thinner market. That's how squeezes start. Not with a green candle, with a cleansing. Now I'm going to give you the single behavioral tell that decides whether today's silver crash is bearish continuation or a flush that sets up the next leg. This is the tell, what happens after the slam. If silver gets slammed and stays down, buyers are absent, bearish. If silver gets slammed and snaps back fast, selling was mechanical and demand is waiting, bullish for squeeze risk. You don't need 50 indicators, you need one truth, rebound speed. Now about the number in the title, gold 54 and 17. Different feeds report different prints depending on spot versus futures versus CFD versus contract month. Some outlets referenced continuous futures in the mid 5,300s in the same window, while other briefs cite gold around $5,400. barons.com, so treat $5,417 as the print on your screen. The exact tick doesn't change the message. Gold at extreme levels while silver whips violently is the signature of a stress regime and fragile liquidity. Now, why does war make this divergence more intense? Because war isn't just fear. War is logistics risk. Logistics risk is energy risk. Energy risk is inflation risk. Inflation risk is hard asset fuel. The Guardian's live business coverage described exactly that chain reaction. War drives oil prices, inflation fears rise, markets drop, and safe havens like gold benefit. TheGuardian.com. So gold is the first wave. But silver depends on persistence. If the conflict and energy risk persist, silver can flip from collateral being liquidated to scarcity hedge. That flip is where silver becomes violent on the upside, and that's why today's divergence matters so much. It tells you which wave we're in. Now I'm going to plant 3 open loops and close them. This is the retention engine. Open loop 1. Why gold can climb steadily while silver whips violently. Open loop 2. Why same-day divergence often happens right before the next big silver move. Open loop 3, the 48-hour checklist that tells you which path we're on. Let's close loop 1. Gold climbs steadily because it's deep, institutional, and primarily owned as insurance. Silver whips violently because it's thinner, higher beta, and exposed to forced selling and leverage flushes. That's why you can see sessions where gold surges while silver gives back gains or declines, like Barons described. Barons.com. Same-day divergence is not weird. It's structural. Now close loop 2. Why does divergence sometimes happen right before big silver moves? Because big silver moves require sellers disappearing. Sellers disappear after leverage is flushed. If you flush leverage today and the underlying stress regime persists tomorrow, the next wave of buying hits a thinner market with fewer weak hands left. That's when silver gaps. Silver punishes bulls with drawdowns, then punishes bears with upside gaps. That's how it farms both sides. Now close loop 3, the watch list. But before we do, we need to talk about the 3 traps that wipe people out on days like this. Trap 1. Chasing silver after green candles. Gold makes highs, silver pops, people chase, then forced selling hits and silver dumps. They panic sell at the low. Trap 2, panic selling silver after red candles. Silver drops 7%, people conclude the story is dead. Then forced selling ends and silver rebounds. They buy back higher. Trap 3, treating every move as permanent. In war regimes, markets reprice probability, not certainty. Premiums expand and compress fast. That's why you need a checklist, not belief. Now the binary scenario map. Scenario A, event premium fade. Gold spikes, then fades as the market de-risks. Oil gives back gains. Silver keeps bleeding because buyers were mostly speculative. Today's silver crash becomes a larger unwind. Scenario B, stress persistence regime. Gold holds firm because fear and inflation risk remain. Oil stays elevated. Energy logistics risk stays active. Silver slams get bought faster and faster. Today's silver crash becomes a leverage flush that sets up the next leg. Now, which scenario are we in? We don't guess. We watch. Here's your 48-hour checklist. Binary, screenshot worthy, test 1. Gold hold. If gold holds near these elevated levels across the next sessions, fear is persistent, not just a one-day spike. Investopedia.com. If gold fades hard, the market is de-risking the war premium. Test 2, silver rebound speed. If silver rebounds quickly after slams, fast bounces, selling was mechanical and demand is sticky. If silver keeps bleeding and rebounds are weak, buyers aren't committed. Test 3, oil and inflation pulse. If oil remains elevated, inflation fears stay alive, and hard assets keep a bid. Investopedia.com. If oil collapses back, urgency fades and silver often cools. Test 4, gold versus silver leadership. If gold holds and silver starts outperforming gold on up days and refuses to underperform on down days, we're transitioning from trust hedge to friction hedge. If gold holds and silver continues to lag, we're still in gold-only fear. Test 5, volatility signature. If you keep seeing violent intraday swings, silver up early then down later, this is consistent with thin liquidity and ongoing positioning cleanse like Barons described. Barons.com. Now stop. Here's the line that ties the whole video together. Today wasn't silver failing. Today was silver showing you collateral stress. Gold is the safe haven destination. Silver is the battlefield where the system flushes leverage. That's why the same-day divergence is one of the most important signals you can get in a war regime. Because it tells you whether we're still in wave 1, gold-only fear, or transitioning into wave 2, hard asset repricing and friction. Now I'm going to make this emotionally clear because this is where people either level up or get farmed. You saw war headlines, you saw gold at new highs, you thought, finally, the hedge works, then you saw silver down hard and your brain screamed manipulation or it's over. Right there, right in that emotional spike, is where the market farms people, because emotional certainty creates bad timing. So I'm telling you, this divergence is not a glitch. It's a feature. It's the market cleansing weak hands under stress. Now the honesty wedge, because credibility matters. Sometimes a silver crash is just a crash. Sometimes it signals real weakening demand. That's why we rely on behavior after the slam. If silver can't bounce, that's weakness. If silver rebounds fast, that's mechanical selling ending. That's how you stay honest. That's how you stay alive. Now the final cliffhanger that decides everything. When the next silver slam hits, does it get bought like a hedge or dumped like a trade? Because that one behavioral answer tells you whether today was a breakdown or the setup for the squeeze phase people only understand after it's already too late. This isn't financial advice. This is financial warfare education. Drop same day if you want me to map the next 48 hours using the checklist. No hype, just structure.